my name is Schyler Church. I am a California real estate broker as well as a member of the education department at Accredited Real Estate Schools. We offer those courses to be eligible to take the state exam in California, but also a bunch of different tools to help you prepare for the state exam to make sure you're prepared to pass it. One of the tools that we use is practice questions, and today we're going to talk about a few practice questions. And hopefully it'll give you a little bit of an idea and assist with your studies of how well you're doing with the material so far. But if you want access to our entire database of practice questions, which is over 3,600 questions specifically for California, make sure to check out our link below as that goes over our video, our practice question program, our video program, our live class options, tons of options, as well as if you need the courses. So let's get to it. And start with the first question. 1. If the seller changes his mind regarding selling a property and the buyer wants to gain access to the title, what could the buyer do? A. File an interpleader action. B. Record a mechanics lien. C. Start a suit for breach of contract. D. Institute a suit for specific performance. As always, let's break down the question and see what it's asking here. So a seller decides that they just don't want to sell the property anymore. What can the buyer do to actually make the seller sell the property to them? Well, there should be something that's automatically coming to mind. Yes, you need to take them to court, but what do you need to take them over to court with? Well, it's called a suit for specific performance, to make the seller perform the action of conveying title to the buyer. Now, for specific performance to actually happen, the consideration has to be sufficient. So you can't make a seller sell it to you. Let's say they signed a contract to sell a house to you for $100. The house is worth $300,000. That's not going to happen. You cannot make the seller sell the house to them in court if the consideration is not sufficient. And then let's just look at the other answer options just to verify. Well, interpleader action, remember that is something that should be kind of coming to your mind when you think of escrow. If there is a issue with like the deposit, for instance, the earnest money deposit. What about a mechanics lien? Well, that is an encumbrance, remember that, but what is it exactly doing? Not in this particular situation. This would be something if a contractor, a subcontractor, somebody that is not getting paid for their work for the property, they would record then a mechanics lien on the property against a property owner, but that's not in this particular case. Breach of contract. Yes, it could be a breach of contract, but for the buyer to gain access to the property, this buyer would need to institute a suit for specific performance. So the best answer is specific performance. 2. How many days does a buyer have to cancel a purchase after a real estate transfer disclosure statement is hand-delivered to the buyer? A, 1 day, B, 3 days, C, 7 days, D, 17 days. Well, remember, with real estate transfer disclosure, that is required in the sale of a 1 to 4 unit residential property. There are several exceptions to this, but any transaction you do that's a 1 to 4 unit property will be required for a seller to provide a real estate transfer disclosure statement. We call it a TDS. Well, that TDS goes over a lot of pertinent information that the buyer will want to be aware of when purchasing this property. So anything that the seller has knowledge of for defects to the property, important info about it, asks a lot of questions and explanations about certain items. And if that, when that transfer disclosure statement is provided to the buyer, well, the buyer kind of is worried about it. They weren't aware of it, or something just that really concerns them. Even if they are out of the contingency time periods, for instance, like the physical inspection contingency, what will happen is the buyer still has 3 days from that TDS being hand-delivered to the buyer to back out and cancel the purchase. So 3 days. That is the correct answer. Also, if the seller amends the TDS, after already delivering it, the buyer has another 3 days to then decide if they wanted to cancel it. So 3 days is the correct answer here. 3, which appraisal approach requires a separate value of the land? A, market data approach, B, income approach, C, cost approach, D, sales comparable method. Well, what are the 3 approaches that should be coming to mind automatically? Well, A, B, and C. We have the market data approach, the income approach, and the cost approach. So let's break down these 3 main approaches. So we have the comparison approach, which is the market data approach. This uses the principle of substitution because it's also the most readily adaptable and usable approach. And because it's one that you're able to use and compare other properties to it, it's most often used with single-family homes and unimproved land, vacant land, because it's easy to compare land to land, looking at if there's no improvements on it, what's the acreage, what type of land. You can kind of compare what it is easily with other land in the area. But then also with single family homes, so like tract homes, properties that just have one building on it, those are, there's so many residences and developments out there of single family homes, so they're easier to compare with. So when you're doing as a licensed real estate agent and assisting buyers and sellers coming up with an appropriate purchase or a list price, you usually will be using the comparison approach, which is the market data approach, and using sales comparables to find out what the current market is shaping up to be, and what it also is indicating of price points for features and types of properties out there. So you can use the principle of substitution to do so. And then we have the income approach, capitalization approach. This basically is used for investment properties, income properties, because it's used to appraise the value of income producing properties by converting an income stream into value. It takes what it will be yielding as income for the property and puts a value on it based on the amount of money it's making and the riskiness of the investment. That's why it's called also capitalization approach, because it's taking a look at the capitalization rate. And this is used commonly with multi-unit residential apartment buildings, leased investments, so commercial properties as well. Sometimes we'll use this. But remember, with an appraiser, they'll be looking at all 3 of these approaches. There just might be a more heavily emphasis on certain approaches when they're doing the reconciliation purposes of it. And then there's the cost approach. So the cost approach looks at the actual cost to build a building, so a house, for instance, an improvement on a parcel of land. And they take that cost to build the improvement and adds it to the land value to determine the overall property value. And so this is very good to use with like special purpose and service buildings, new residences, new construction, older homes, properties that are rare, unique. They're hard to compare. And so the cost approach is used for that because they just look at the actual cost to build the improvements and then use the value of the land, add them 2 together, and then they get a value for the overall property. Now, looking at this, the cost approach, as you can tell, there's 2 different elements to it. We're looking at the cost of the land. Well, how do we get the cost of the land? Well, in the cost approach, we look at the we use the market data approach to find the value of what the land is in the marketplace, to then add that with the cost of the improvements. And that's how we get the overall value for it. So when looking at the question that we have, let's review it. Which appraisal approach requires a separate value of the land? Well, out of all of these, separate value of the land, from what we've talked about, the only one that makes that separate valuation of the land is the cost approach. So the cost approach uses it and has a separate valuation of the land by using the market data approach to get a value for the land, and then looks at the cost to add to build the building or whatever type of improvement is on the parcel of land, adds those 2 numbers together to get an overall value. So it looks at it individually, whereas the comparison approach looks at it as a whole, and it uses the principle of substitution for the entire property, looking at the land and the improvements rather than them separately. and then adding them together. That's only done for the cost approach. And the income approach doesn't even really look at the land. It looks at the actual income producing elements to the property. So the best answer is cost approach. The cost approach requires a separate value of the land and then adds that value of the land with the cost to build the actual improvements. 4, a salesperson did something unethical. Who is liable? A, salesperson only, B, broker only, C, salesperson and broker, D, salesperson, broker, and escrow officer. So there's a few things you need to know about to be able to answer this question. In California, when licensed as a real estate salesperson, you have to place your license under a real estate broker to be able to practice. That is a requirement by law. So because of that, there's something called vicarious liability. So the broker is then roped into anything these salespersons or broker associates that are under their license do. The broker is expected to manage and supervise all of these licensees that work under the broker. So there is a little bit more liability to a broker because of the fact of vicarious liability. The broker is also roped into whatever the salesperson does, that as long as the salesperson is under their license. So for this particular question, the salesperson is liable, the broker is liable. Is the escrow officer liable? No. Escrow officer is a neutral third party to assist with satisfying the terms of the contract. So the escrow officer is not involved in this liability for something unethical happening. Unless, of course, if an escrow officer did something differently, they could be held to a different type of standard. But we're talking about the salesperson in this particular question. So the best answer is C, salesperson and broker. They are both held liable for anything for something that a salesperson did that was unethical. The salesperson, of course, is the one that did the action, but because the broker has to supervise the salesperson and approve anything that the salesperson does in regards to a transaction or for what's happening, the broker needs to have full control over their brokerage and the licensees under them. Then the broker is also held liable for the unethical action performed by the salesperson. So vicarious liability. Now, I know a lot of people sometimes are worried to get their broker's license because of this, but this is if you had if you have salespersons working under you. You can be a broker and be a broker associate working under somebody else. You can have your broker's license and just work for yourself without having any other licensees under you. So then you become more liable, yes, as a broker, especially if you are having salespersons or broker associates work under you. But you do have a lot more freedom by not having a broker over your shoulder. So keep that in mind. A lot of people sometimes are worried to upgrade their license type from salesperson to broker, but I do recommend it at least sometime in your career to get your broker's license because it does make it easier for retirement purposes. But it's all personal preference. You can stay a salesperson throughout the entire real estate career without issue. But I myself became a broker within 2.5 years of salesperson experience because I like doing my own thing, but that's just me. So let's move on to the next question. 5, Abel, Baker, and Charlie are owners of a vacant lot. They hold title as joint tenants. If Abel dies and is survived by Baker and Charlie, which of the following is correct? A, the joint tenancy is totally terminated. B, Baker and Charlie receive Abel's interest by succession. C, Baker and Charlie receive Abel's interest by survivorship as tenants in common. D, Abel's interest terminates. So this question has a lot to it. They're talking about joint tenancy, Abel, Baker, and Charlie owning a vacant lot as joint tenants. But if one person dies, and in this case Abel, and Baker and Charlie are left, what happens? Or which of the following options is the most correct? Well, we first need to talk about joint tenancy. So what should be coming to mind as joint tenancy? So remember, there's a lot of forms of concurrent ownership that can happen. There's tenancy in common, there's joint tenancy, you can have a partnership, corporation, you can do a syndication. There's so many options here. But what do we know about joint tenancy? Well, joint tenancy, you should be thinking of T-tip, right of survivorship, and being free of unsecured debts. Now, what does T-tip mean? Remember, that just means that the joint tenants must take title to the property at the same time, with the same title instrument, usually just a grant deed, Their interest must be equal, and it has to be equal possession. So time, title, interest, and possession, T-tip. But then we also have the right of survivorship. So what happens on a right of survivorship is that if someone were to pass away in joint tenancy, the other remaining parties as joint tenants will take over for that person that passed, and that would still be kept in joint tenancy. And then the interest in the possession of, et cetera, that would then be proportionate to whatever part that the other person left. So in this case, everybody had a 33 and a third, or a third, third, and third, and then now it would be with two parties left, half and half to the remaining parties as joint tenants. So what do we know is the most correct? Well, let's look at the answer options. The joint tenancy is totally terminated. That is not correct because the joint tenancy is still held because of the right of survivorship. So A is incorrect. B, Baker and Charlie receive Abel's interest by succession. So what do we know about succession? That's if you die and you do not have a will. Well, Abel may have not had a will, but because he held this title as joint tenancy with right of survivorship, it would go to Baker and Charlie, but not through succession. It would be because of the joint tenancy right of survivorship. C, Baker and Charlie receive Abel's interest by survivorship, yes. Oh, but as tenants in common, no. So they would still remain joint tenants, Baker and Charlie, because Baker and Charlie did receive time, title, interest, and possession all at the same time as joint tenants. So they would still remain as joint tenants. So with process of elimination, it looks like D is going to be the best answer, but let's make sure. Abel's interest terminates. Yep, Abel's interest terminates. That is the best answer because Abel's interest terminates, and so Baker and Charlie will take over for that interest through right of survivorship. So the best answer is D. Abel's interest terminates. Baker and Charlie still stay as joint tenants as owners for this vacant lot. Okay, so let's get to the first question. 1, an acquired privilege to use or enjoy real property that is short of an estate is called A, a lease, B, a lien, C, covenant of quiet enjoyment, D, an easement. So as always, we have to break down the question, figure out what it's asking, and then formulate kind of an idea, and then we can really go through the answer options. So right now it's looking for what is an acquired privilege, so something we acquire that allows us the ability to use and enjoy real property that is short of an estate. So it's not an estate, so it's not a freehold or less than freehold estate, but we're still able to use or enjoy real property, and it's something that we acquire this privilege to do so. Well, let's go through these answers options.
And that answer A is a lease. And what a lease is when someone has possession of the real property but doesn't have the legal title to it. So when we have estates and land, those are ownership interests in land. We have a freehold estate, which is what the owner would have, the property owner, and I'm called the landlord. And then we'd have the tenant. And this tenant would have what we call a less than freehold estate or leasehold estate. And that isn't the estate and land, it's an ownership interest, but not a very big one. It's just basically possession of the property for a very short period of time. So it says short of an estate. So this A would not be correct because a lease would indicate a leasehold estate, and that would not be correct because it's an estate. And then B is a lien, and lien is an encumbrance on property that deals with money.
It's not something that's ever enjoyable.
No, it isn't. It usually isn't. And so liens wouldn't be very enjoyable or privileged use, that's for sure. The covenant of quiet enjoyment, what that has, the tenant has that when they're living in a property. They have the covenant of quiet enjoyment, so the landlord cannot breach this covenant of quiet enjoyment by turning the hot water off or doing things like that. And then the last one, D, an easement. Now, an easement is when someone can actually use someone else's property, and so it's privileged. It's also they enjoy it, and it is short of an estate. So it will be our correct answer.
So the correct answer is D, easement. Now let's go to question number 2. 2. Seller Abel accepted an offer on his home, and the acceptance was communicated back to the buyer. Prior to opening escrow, however, seller Abel received an all-cash offer to purchase the property. He decided to cancel the original contract and notified broker Baker of his decision. Which of the following is most correct? A. Broker Baker has a good legal basis to collect a commission. Excellent chance. B. Broker Baker is not owed a commission. C. Broker Baker is owed a commission if he can prove he is the procuring cause. D. None of the above. So we have to break down the question and understand what it's asking. So it's saying seller Abel accepted an offer on his home. That acceptance was communicated back to the buyer. So knowing that because acceptance was communicated back to the offeror, which was the buyer in this case, there is a valid real estate contract. And then afterwards, that contract was created. But before escrow was opened, the seller received an all-cash offer to purchase the property. So the seller decided he doesn't want to go with the original contract, cancels that contract, and notifies broker Baker of his decision. Which of the following is most correct? And so it's going through, this is basically saying most correct, where they might have a lot of good answer options and they could be correct, a lot of them, but what one, based on the information provided, is most correct?
So in this particular question, this shows you some of the exam questions that they have. This is a practice question that has most correct as the correct answer on it. And so you're having to make some inferences here. First of all, seller Abel accepted an offer on his home. So there's a buyer that, that made an offer and the seller accepted it, then communicated back, of course, to the buyer, which then it's required in real estate contracts. So now you have the contract to purchase it. And then if the seller gets a better offer, all cash, decides to accept that one and not take the first one. Now he has a contract with the buyer on the first one. In that contract, it states that broker Baker is going to be paid a commission most likely, and that's reason is because the most common listing agreement that we use in California for resale single-family homes and a lot of commercial investment is their exclusive authorization and right to sell listing agreement. It says basically that no matter who sells the property, broker Baker gets paid a commission. So he changes to another offer, but Baker is still due a commission on this, and he's of course probably trying not to pay it. And so Baker would have a good legal basis to collect the commission, excellent chance on the state exam. In the real world, it's a little harder to collect these because what happens is the commission may be earned when the actual agreement was put together with the first buyer and it was accepted and communicated back to the buyer. But the problem we run into in the real world is that usually we get paid after close of escrow. And so if there's a dispute, it's difficult to legally get a commission until there's a close of escrow. In this case, that did not happen on the first deal. It would happen on the second one. But for city exam purposes, the right answer is A. Broker Baker has a good legal basis to collect a commission or excellent chance.
Very much so. And so it's basically being able to understand the concept, apply it to the question, and understand that there could be multiple possibilities of the question. The answers could be correct, but it's just taking what the information is provided and going with the most correct option given the information provided. And that's really, it's sometimes hard to figure it out, wade through the information, figuring out what you know, putting it together, and which one is the better answer. And
what it comes down to is understand the actual theory of what they're talking about, which, you learn the theory. Then you also have to go through the practice questions, practice state exam questions, and understand the gamesmanship of the questions and how they're phrasing these questions, because and the more knowledge you have, then you'll also be able to eliminate a lot of the wrong answers, because there are the right answers on other questions, but there are wrong answers on these questions. So if you could see broker Baker's own commission, if you prove he's the procuring cause, then, well, if it was an open listing, that might be the case, but open listings are not the predominant listing agreement used in California. It's exclusive authorization right to sell, and so you can eliminate some of these things a little bit, but the thing is we're making a big assumption here on the exclusive authorization right to sell being used, because it's not even in the question. So that's why you have to go through a lot of questions and really, really kind of understand how they're putting these together so you can pass this.
The train of thought behind them.
Yeah, pass the exam.
The reasoning behind the question.
Yep.
Okay, so question number 3. Jones gave Smith a power of attorney to sell his home. All of the following statements are correct, except A, if Smith is notified that a court has ruled Jones to be incapable of contracting, the power of attorney is terminated. B, before Smith may sell the home, the power of attorney must be recorded. C, if Smith finds that Jones's property is the subject of a declaration of homestead, he cannot legally convey the property. D, Smith may legally deed the property to himself only if the selling price equals or exceeds the fair market value of the property. So Jones is giving Smith a power of attorney. So Smith is the attorney in fact for Jones to sell Jones's home. All of the following statements are going to be correct except one of them. So what we're having to do is identify the one of the 4 that is an incorrect or a false statement. So 3 of them are correct, 1 of them is wrong. The wrong one is going to be the correct answer. So let's go through them and see based off of what we know.
So A, if Smith's notified that a court has ruled Jones to be incapable of contracting, power of attorney is terminated. Yeah, that's correct. B, before Smith may sell the home, the power of attorney must be recorded for the real property. Yeah. C, if Smith finds that Jones' property is a subject of a declaration of homestead, he cannot legally convey the property. Yes. And then D, Smith may legally deed the property to himself only if the selling price equals or exceeds the fair market value of the property, and that is incorrect. So that's the answer you're looking for, which is going to be all the following are correct except for D as in David. Smith may legally deed the property. Because the reason is because when you get a power of attorney, you're what we call an attorney in fact, and you can't deed the property to yourself. You're supposed to deed it to whoever they're going to be, who's another third party, but not to yourself. So that's why D is the incorrect, so it's the right answer.
They have it this way, so Smith can't take advantage of Jones, and that would be unconscionable, is really what, if he was going to do that. So, yep, D would be the correct answer because it's the wrong answer.
Yeah.
Moving on to question number 4. An FHA loan will, and a VA loan will not, A, provide for the purchase of a duplex purchased for rental. B, allow the buyer to take title subject to the existing loan. C, charge a prepayment penalty. D, all of the above.
Well, the FHA is part of the Department of Housing Urban Development. It's a federal agency, and they insure loans made by approved lenders. So the borrower wants a loan, they go to a lender, and the lender asks FHA, will you insure the loan? FHA says yes. So the borrower then makes payments. Let's say they go into default, and the lender doesn't get all their money back. Well, FHA is on the hook to pay for that their losses. So that makes it good for the lender. And FHA allows 1, 2, 3, and 4 unit properties as long as the owner is living in one of them. So a single family or a condo, it could be a duplex, which is 2 units, a triplex, 3 units, or a fourplex or a quadruplex, which is 4 units. As long as the borrower is living in one of them, then you're in good shape. Now with the VA loan, the Department of Veterans Affairs is a federal agency, and they guarantee loans made to to veterans by approved lenders. So lenders will make a loan in the same situation VA guarantees, just like FHA insures. And VA will usually only do single family homes, owner occupied. That's what they're really looking for. So the difference here is that FHA will provide, if you wanted to buy like a duplex, they would allow you to do that. Mm-hmm. So the answer, provide for the purchase of a duplex purchased for rental, would be correct on that.
Because FHA will, VA will not allow that.
Correct.
Question number 5. A non-licensee purchases a home himself, knowing he can immediately sell it for more money. Which of the following is most correct? A, he can be punished. B, this is perfectly legal. C, illegal. D, none of the above. So we're talking about somebody without a real estate license that purchases a home knowing that they can immediately sell it for more money once they purchase that home. Well, what is the best answer, the most correct answer in regards to a non-licensee obtaining a secret profit? Well,
This is perfectly legal because just a good, sharp business person is what it comes down to. You don't get too many sellers who you're able to do that with. Now, if you were a licensee, you actually had your real estate license, and you were able to purchase the home and then resell it immediately after. That's called a secret profit, and that is illegal. You cannot do that as a real estate professional, real estate licensee. But a non-licensee who purchased a property, himself, and he can resell it, that's no big deal. He's just a good, sharp business person. But again, the sellers are usually not going to make that kind of mistake. Now, the reason that the licensees get into trouble on this is because the sellers and the buyers, and especially the sellers in this case, are relying on them to help them price the property, because they would be maybe the listing agent on the property. And so since they're relying on them, you can't go and buy the property and then resell it. They call this a double escrow, and you'll see those more in commercial than in residential sales. But that's why a lot of people may not get their real estate license, because they think that they can do more of these double escrows, which are not real common. What I found is you actually save more money getting the real estate license, and then saving money when you you get the buy side commission when you purchase, and then you save some commission on when you sell through the MLS type thing.
and then you can look at the properties yourself and not have to get another party involved to show you these houses.
Right, do
And these
yourself.
investments.
Exactly.
So yes, B, this is perfectly legal. I know when you see perfectly legal, you would think that cannot be the correct answer, but when it's coming to a question like this, but it is when you do not have a real estate license. So that is the most correct answer option.
And you got to really watch these questions, because they've got a lot of little tricks in there that if you don't really do your studying, they'll get you on those. But if you study, you should do fine.
Exactly.
One, a real estate broker advertises that if a buyer buys from him or a seller lists with him, then he will pay the party $50 from the fee or commission he receives from the transaction. The broker A, can do this, B, cannot do this as it is a violation of the Business and Professions Code number 10176. C, can credit the buyer's escrow account with $50, but he could not compensate the seller. D, can give a rebate of commission to the seller, but he cannot pay the $50 to the buyer. As always, let's break down the question. So we're talking about a broker who's advertising that if a buyer buys from him or a seller lists with him, then he'll pay either of the parties $50 from the fee or commission he receives from the transaction. So what do we know about this? Well, for state exam purposes, what is allowed? Well, a broker is allowed to give money to either party if it is disclosed to both parties. So disclosure is key here. But they're just asking overall, not really over the specifics of it, can the broker do this? Yes, the broker can do it as long as it is disclosed, but they're not really asking about the disclosure part of it. So yes, the broker can do it. It's not a violation of the Business and Professions Code. It's not asked. It's saying, can you credit the buyer but not the seller, or the seller and not the buyer? No, you can do it for the buyer and seller as long as it is disclosed. So the best answer out of all of these is A, the broker can do this. Now, in the real world, it's very, you want to make sure you consult with your broker to make sure you can do this, because it can get tricky and a lot of brokers don't like you doing this. So there's a lot that can go into it. So you want to make sure that you check with your broker before doing this, because it can muddy the waters and it could get you into trouble if it's not done properly. But overall, for state exam purposes, it can be done. 2, for tax purposes, an owner of income property may depreciate A, building, B, land, C, leasehold interests, D, all of the above. Well, we're talking about depreciation from a tax perspective. We're not talking about depreciation for appraisal purposes, because that's very different. Because depreciation, though, for tax purposes, that is a paperwork loss that the IRS lets us take as a tax deduction on income properties. This does not include principal residences. So you have to know income properties, you can depreciate the property. Of course, there's limitations on it as well, but for income properties, you can depreciate it and have it as a tax deduction either on a 27.5-year basis straight line, or you would have the 39 straight line depreciation. My brain is not working. So we're talking about depreciation for tax purposes, and it's very different than depreciation for appraisal purposes. Because remember, from tax purposes, depreciation is a paperwork loss that the IRS lets us take as a tax deduction on income properties. Now, there are limitations to it, but income property, and it also, so it cannot be like your personal residence. It has to be an income property, and then you can depreciate it, and it's a return of your investments. Now, what can you actually depreciate though? Remember, there's straight line depreciation that is allowed on either a 27.5-year straight line for residential or 39-year for commercial. But what can we actually depreciate on that straight line schedule? Well, you have to know land is never, ever, ever depreciable. Land does not wear out, so you cannot depreciate land. But the improvement, so a building can be depreciated if it fits the depreciation parameters set forth by the IRS. And the building is then able to be depreciated. Leasehold interests, nope, that's not able to. All of the above, no. So the best answer is a building. The building can be depreciated when we're talking about from a tax perspective. The land, though, can never, ever, ever be depreciated. Land does not wear out, whereas a building does. So that is what you need to make sure to keep in mind when thinking of depreciation. And remember of the straight line schedule of the 27.5 for residential and 39-year for a commercial property. So make sure to keep that in mind. So let's get to question number 3. 3. Which of the following can an unlicensed receptionist not do for a broker? A, call for the broker. B, schedule appointments for the broker. C, advertise for the broker. D, file paperwork for the broker. Well, we're talking about an unlicensed receptionist. So a lot of receptionists or assistants, brokerages like to have them licensed because when you do not have a license, you are limited on what you can do. And so what can you not do as an unlicensed person? Well, as the first thing that should come into mind, you cannot solicit for business on behalf of the broker. You can do introductions, but you cannot solicit for business. But that's actually not an answer option here. So what else can you not do? Well, what can you do? You can do clerical administrative work. So you can call for the broker, nothing that deals with negotiation, nothing that deals with actual important information about the transaction or a client, but trivial administrative tasks you can call out for the broker. You can schedule appointments for the broker, so schedule inspections, appointments that the broker might need to go to meet clients, clerical and administrative tasks. So you can file paperwork for the broker. These are very tasks that do not require a real estate license. But what does require a real estate license? Advertising for the broker. An unlicensee cannot make an advertisement on behalf of the broker. Now, the unlicensee can place an advertisement created by the broker, but the actual unlicensed person cannot create the advertisement or advertise for the broker. They can place already created advertisements by the broker, but not actually create the advertisement. So in this question, I know it's a little vague, but advertise for the broker is not allowed by an unlicensed receptionist for a broker. Anybody without a license. 4. A person enters into a contract and agrees not to terminate the contract for a certain period of time. This is called A, option, B, novation, C, subject to, D, power of attorney. So what we're talking about here is there's a contract that somebody has entered to and it remains open for a period of time. So it's not actually terminated for that time period. What is that called? The first thing that should be coming to mind when you're talking about this, a contract remaining open, it is an option. So the person will still have the option to be able to act on that option and actually exercise that option. Whereas novation, that's just replacing something old with something new. Subject to, that's dealing with taking like a property subject to versus an assumption. Power of attorney, no, that's just deals with attorney in fact. So no, the best answer is A, option. And then let's go to the question number 5. 5. The primary purpose of the California Department of Real Estate Recovery Fund is A, for members of the general public who hold an uncollectible judgments against a licensee to collect limited damages. B, allow real estate salespeople to collect commission against their brokers. C, allow aggrieved buyers and sellers to collect an unlimited amount of damages from the Department of Real Estate. D, all of the above. So this recovery fund is like a fund of last resort for a member of the public who has obtained a final judgment against a real estate licensee and has been unable to satisfy that judgment through normal post-trial proceedings. So basically, it's the primary purpose of this DRE's recovery fund is for members of the general public who've been defrauded by a real estate licensee and or trust funds converted, for instance, and they have an uncollectible judgment against that licensee to collect those limited damages. And so to do so, they would then be able to be paid out by this recovery fund. Licensees pay into the recovery fund. That is what a portion of the license fee goes to, is this recovery fund. And if a payment is made from the recovery account, the license of the debtor of the judgment is automatically suspended until it's been repaid, plus any interest. And there are limitations, though, also on this recovery fund. So it's limited to $50,000 per transaction, as well as $250,000 maximum per licensee. So it could be then prorated as well, because what we're talking about, if there's multiple people harmed within a transaction, it's limited to $50,000 for that transaction, and it would be usually prorated then between the parties that are harmed and hold an uncollectible judgment. Overall, though, for one licensee, the maximum amount that can be paid out is $250,000. So what are we talking about here, though? Now that we know all of this, what is the best answer? Well, let's kind of go through it. Is it for members of the general public who hold uncollectible judgments against a licensee to collect limited damages? Collect limited damages. Yep, we've talked about that. B, allow real estate salespeople to collect commission against their brokers. No, this is for people of the general public for uncollectible judgments that they have against the licensee. So no, remember, if there's a commission dispute, that is something that would be handled in the court, and they would also not use this recovery fund as a last resort. It's for the general public. C, allow aggrieved buyers and sellers to collect an unlimited amount of damages from the Department of Real Estate. No, it's limited, as we've talked about, for numbers. So the best answer is A, for members of the general public who hold uncollectible judgments against a licensee to collect limited damages. That is the primary purpose of the DRE's recovery fund or recovery account. And so that is the primary purpose. And it was formed in 1964. Only since 1964, though, there's only been 4,000 applications for it. So not too many, but they also say, though, over 50% of all claims filed have been paid in full or in part. And so this has definitely been a good fund for last resort for the general public who can't collect their judgments against the licensee that harmed them. So you need to know about this. It's important to know about for when you're practicing, but also for state exam purposes. Most likely we'll get a question on it. In the event a buyer of a single-family owner-occupied residence defaults under a purchase contract in which both parties had initialed the liquidated damages clause, the maximum the seller can retain would be A, nothing, B, 50% of the deposit not to exceed 2.5% of the purchase price, C, 3% of the purchase price not to exceed the amount of deposit, D, the entire deposit regardless of the amount. Well, what do we know here in California? Well, if the liquidated damages clause is initialed by both parties in a contract of a 1 to 4 unit residential property in California, then liquidated damages is limited of 3% of the purchase price not to exceed the earnest money deposit. So basically it is whichever's lower, the earnest money deposit or 3% of the purchase price. Whichever is lower is the one, then that is the maximum that the seller can retain, because remember, liquidated damages is the amount, it's a predetermined amount that the seller can keep if the buyer were to breach the contract. And in California, it's 3% of the purchase price not to exceed the amount of deposit, and that's the maximum the seller can retain. And that's only if, remember, the liquidated damages clause is initialed by both parties, so it's been implemented. And in California, that is the correct answer for a single family owner occupied residence when liquidated damages applies. 2, Abel paid a property owner $100 as consideration for an option to purchase a property. The option contained a clause stating that the option was to be for a duration of 60 days from June 1st, 2020, and upon exercising the option, the holder is to purchase the property for all cash within 30 days thereafter. On July 10th, 2020, Abel sold and assigned his option for $1,000. On July 28th, 2020, the new holder of the option notified the owner that he would purchase on August 15th, 2020. The owner claimed the option was void. Which of the following is true? A, the option was invalid. B, the option was illegal. C, the option was valid and the assignee could purchase the property on August 15th, 2020. D, none of the above. Well, let's dissect the question. So Abel paid a property owner $100 as consideration for an option to purchase the property. As you remember, an option is just like an open offer to purchase the property. Yeah, that was my cat. I'm sorry. Keeping things interesting here. She wanted to join in. So $100 for consideration for an option to purchase a property. But the option had a clause stating that the option was to be for a duration of only 60 days starting on June 1st, 2020. And upon exercising the option, the holder is to purchase the property for all cash within 30 days thereafter. So they have 60 days to exercise the option, but then after that, if they do exercise the option, they then have to pay within 30 days all cash to purchase the property. Well, on July 10th of 2020, so that's about 40 days in, Abel sold and assigned his option for $1,000 to someone else. Well, so Abel is the assignor, and there's an assignee now. Well, the assignee on July 28th, 2020, notified the property owner that he would purchase the property on August 15th, 2020. Now, the owner is saying that this is void. Well, what is actually true? Well, the option can be assigned, and it would be void, though, if it is exercised after the 60-day mark of June 1st. July 28th, though, falls within the 60-day mark, and that is then a valid option, and the assignee is then able to, then as long as they close it within 30 days, so August 15th falls within the 30 days of the option being exercised and does so with cash, then the property owner needs to hold up their end of the option. And so the correct answer option is the option was valid and the assignee could purchase the property on August 15th, 2020. That is the correct answer. 3. appraisal value takes into consideration A, physical characteristics, time and location, B, physical characteristics, time and loan, C, physical characteristics, time and depreciation, D, none of the above are correct. Well, let's look at here. We're talking about appraisal value. Remember, there's a lot that goes into a value. There are a lot of perspectives on it and a lot of definitions to value. We're talking about from an appraisal perspective though. So what does the appraiser take into consideration? I'm gonna apologize in advance. I'm not gonna really do a ton of editing on this video, so you're probably hearing my dog in the background as well as my cat. You're just getting the full experience from the Schyler household today. So let's get to the question though. So, well, as you can see, there is a common denominator of physical characteristics and time. We first need to figure out, are those two correct? Otherwise, it would be none of the above. Well, physical characteristics, that definitely is taken into consideration when valuing a property. When looking at value of a property, physical characteristics, what the property looks like, what it consists of, the condition of it, that's all taken into consideration for value. As well as market timing, so the time, that is taken into consideration. How's the supply and demand? What's the market like? And that's really important when looking at value. And then also location. Let's talk about that because location, loan, and depreciation. Those are the three that then that's basically differentiate the answer options. Location, yes. Location you should always think about. That is really, really important for a property. A value. If a property is right next to an airport where there's a lot of sound and a lot of noise versus a property that is really quiet and secluded, that of course is going to take into consideration that. And that's also taking into consideration economic obsolescence there too. Well, loan, no. A value doesn't take into consideration what was used for financing purposes to procure the property, so acquire the property originally or for a new purchase as well. That doesn't matter. So the financing versus all cash does not take into consideration. And then we have depreciation. So depreciation is actually, it could be looked at from an appraisal standpoint or also from a tax perspective with the IRS that lets us take a paperwork loss. But if we're looking at it from an appraisal standpoint, yes, depreciation is taken into consideration as well. So from looking at it from a physical deterioration, functional obsolescence, and economic obsolescence standpoint. However, so looking at that, we can eliminate B and D. A and C are the better answers. Which one, though, is the best answer? Well, the best answer is physical characteristics, time, and location. Why is that the better and the best answer? Well, these three take into consideration it takes into consideration the physical deterioration, the functional obsolescence within the physical characteristics, as well as time and location. That location takes into consideration the economic obsolescence part of it. So that is the better answer. And then also location takes into consideration a lot of other aspects as well of what it is in the market, socioeconomics. It takes into a lot more into consideration than just depreciation. So if that A was not an answer option, C would be the better one. But because A is an answer option, that is the best answer. And as you can tell, this state exam, as you know, there's always usually maybe two good answers. You just have to figure out which one's the better, best answer. And that's where hopefully these questions and practice tools are helping you with your studies. Question number 4. As a matter of practice, the escrow holder is authorized to A, order the termite inspection and authorize any corrective repairs to be made. B, advise buyers on best financing available in the marketplace. C, amend the commission instruction form at the request of the listing broker. D, call for funding of buyer's loan. Well, what can an escrow holder, escrow officer, escrow agent, what can they do? Well, let's go through and do process of elimination and figure out what is the best answer. So looking at A, order the termite inspection and authorize any corrective repairs to be made. No, an agent can order the inspection on behalf of one of the principals of the transaction, but any corrective repairs that need to be made, they need to be agreed upon by the seller, and then also, for instance, the buyer too. They just need to be agreed upon, ultimately needs to be agreed upon by the seller, and that then needs to be ordered by the seller or the agent on behalf of the seller. Or if the buyer was wanting to pay for it ahead of time, which is not recommended, or the agent on behalf of the buyer. So the escrow officer does not deal with that. A is not the correct answer. Then we have B, advise buyers on best financing available in the marketplace. Escrow holders, escrow officers, they are just an independent third party, a neutral party that assists with satisfying the terms of the agreement. So they help on getting the transaction to come to perfection, to close. That's what they do. They're an independent third party. Due to that, they do not deal with actually assisting a buyer in finding what's the best financing for them. They are not a loan officer. They are an escrow officer. They only assist with getting everything together for the transaction to satisfy the terms. So they're that neutral third party. The loan officers, they're the ones that will assist the buyers on finding the best loan for them, the best financing option in the programs available to them in the marketplace, and they are licensed to do so. Escrow officers are not. They cannot help you find your financing. You have to come in with the financing to escrow already in place. C, amend the commission instruction form at the request of the listing broker. No, they cannot amend it. The listing broker has to submit a new commission, what we call it, a broker demand to escrow. They cannot amend it on behalf of the listing broker. That is not something that they can do. The listing broker, with anything that deals with the commissions, whether it's being a decrease in the commission or how much the commission is going to be, or how the commission is being dispersed or distributed, that has to come directly from the agent. It cannot be amended by the escrow holder. So based off of process of elimination, A, B, and C are incorrect, but let's verify that D is correct. Can the escrow officer call for funding of a buyer's loan? Yes. The escrow holder can contact the loan officer to then get the funding of that loan. They are not actually the one doing the work to get it funded, but they can call for it to be funded for those funds to be sent to escrow. So that is something that they can do. So the correct answer is D, call for funding of buyer's loan. That is something that the escrow holder is authorized to do as a matter of practice. 5, when a buyer receives a commitment from a lender to provide funds if needed by the buyer, this is called A, construction loan, B, standby loan, C, FHA loan, D, VA loan. Well, it's kind of just a definition with the term. Well, you need to know what the term is. So what is it called when a buyer receives commitment from a lender to provide the funds if needed by the buyer? So this is being like funds will be provided on demand of the buyer. They've already received approval and the commitment from the lender. They just haven't received the funds in hand, but they can at a later date when the buyer demands so. What is this called? It's called a standby loan. The loan is on standby, ready to go, ready to be funded to that buyer on demand or when it's called to do so. It's not a construction loan. It's not an FHA loan. Remember, FHA, they just insure loans. VA, the Veterans Administration, doesn't deal with that. This is a standby loan. A buyer comes into a brokerage and inquires about a specific property that is not for sale but would like to purchase. The agent notes that the property owner of the specific property is a previous client, so he contacts the property owner. The property owner does not want to sell the property. 2 months later, the agent finds out that the property owner sold the property to the buyer that had inquired about the property to the agent. The agent is entitled to A, full commission, B, full commission plus damages, C, half the commission, D, nothing. Well, let's break down the question as always and figure out what they're really wanting out of it and kind of formulate what our thoughts are based on what the question is asking. So they're saying that a buyer is going into a brokerage and is asking an agent about a property that they would like to purchase, but it's not for sale. Well, that agent realized by looking up that property that the owner is actually a previous client. So the agent goes and asks that property owner if he'd be willing to sell it. The owner does not want to sell it at this time. Well, the agent then finds out 2 months later that the property owner actually did indeed sell the property to that buyer that had originally inquired to the agent about it. What is the agent entitled to? Well, the agent doesn't have an actual, wasn't really representing the buyer at this point. Yes, he had looked into it, and if there was a contract that had gone into there's been a contract and there's been an actual agency relationship established, then possibly the agent could be entitled to a commission. But he wasn't a part of this deal at all. He just did maybe a little bit of footwork, but that didn't actually come to fruition for this property being sold. It wasn't because of him. He didn't help facilitate this deal, this transaction. So he is entitled to nothing. He's not entitled at all to any part of the commission. So he might want to think so, and he could try to sue for it, but there's nothing that's traced back to him for written agreement saying that there's an agency relationship established, and also that the seller would want to sell to somebody with an agent that would be receiving or wanting compensation. So the agent is entitled to nothing. 2. Which appraisal approaches take accruals for depreciation into account? A, market data and income. B, income and cost. C, market data and cost. D, income and market data. Let's look at the 3 approaches then for appraisal. We know market data, income, and cost. Market data uses the principle of substitution primarily. It's the most easily and readily usable approach that we can use as real estate agents, but also for appraisers, because you just look at the characteristics of other properties and you compare, you make substitutions and adjustments accordingly. But does that take into consideration depreciation? No, it doesn't specifically take into depreciation. It looks at the characteristics of it. Now, the income approach. The income approach is, remember, it's used to basically converts what we think of an income stream into value. It also takes into consideration like the capitalization rate, a lot of different things. And so it's basically used for income producing properties to then create a value for it and what it's valued off of based on the riskiness of the investment, a bunch of different factors as well. But so when we're looking at that, they're also going to be looking at the income stream. And a lot of the times the income stream is going to be affected of what you can actually have take home. Well, with that, there is a type of depreciation that the IRS lets us take. It's a paperwork loss on our taxes because the IRS believes that properties do wear out and they lose value. So it's something that we can take monetarily on our taxes every year. So remember, there's a straight line depreciation that we're allowed in real estate for residential of 27 and a half years and commercial 39 years. So that's a depreciation that we are allowed to take, and that is within the income approach. Now, what about the cost approach? The cost approach looks at what it is to actually build the property with today's materials, or with what it would be actually to produce that property right now and how much it would be. So we use the market data approach to value the vacant land, the unimproved land, but then we use the 3, remember, of either the quantity survey, unit in place, or square foot, cubic foot method, any of those 3 to actually get a valuation of the building, and we add it together. Well, when we're getting that valuation of the building, we also have to take into consideration depreciation from an actual physical standpoint as well for loss in value for the actual building due to either physical deterioration, functional obsolescence, or economic obsolescence. So there's two different perspectives of depreciation. One is the IRS paperwork loss that they let us take for income off of our what we're actually going to be taking home, and then there's another depreciation that's taken into consideration for actual, like on a physical level, for the characteristics of the building, and basically what how worn out it is, if it's something styling within the property lines, also what's surrounding it that's causing issues that might be of loss in value. So it's taking into consideration what kind of loss in value it has. So due to that, now we've talked about it, we know market data does not take into consideration accruals for depreciation, but the income and cost approach do. So then the best answer will be B, income and cost. Those approaches, those appraisal approaches, take accruals for depreciation into account. So important to keep that in mind. Two different perspectives, but they're all talking about depreciation here. 3, an agent was the listing agent, but also found and represented the buyer. How much of a commission would the agent be entitled to? A, nothing. B, the commission from both the buyer and seller with their written consent. C, one of the commissions. D, full commission from the seller and half commission from the buyer. Well, the agent is the listing agent, so has the listing. But as also with representing the seller, they find the buyer. And how much of a commission then would the agent be entitled to by representing a listing on the listing side as well as the selling side, so representing both the seller and the buyer? Well, this is now a dual agency, and due to this, the agent now would be able to get a full commission for representing the seller as well as the buyer, as long as it has the written consent, because as you know, dual agency needs to be consented to. And so then the best answer is B, the commission from both the buyer and seller with their written consent. Because remember, as part of the listing agreements, usually you negotiate the compensation. And part of that will usually be saying, hey, the listing agent will be entitled to this amount. Now, if they find and represent the broker themselves or the buyer themselves, then they'll be entitled to this amount. So they'll be representing both parties. Well, they also have a thing in there that says, hey, now when I'm looking though for getting a cooperating agent to bring in a buyer, then that agent would be entitled to a certain commission for representing the buyer. But since this is a dual agency, is basically what they're saying, what kind of commission would they be entitled to from both for representing the buyer and the seller, as long as the dual agency has been consented to. 4, when accretion occurs, who will benefit most? A, the landowner. B, the local government entities. C, the water company. D, none of the above. So what is accretion? Well, accretion falls under accession. And remember, accession is a way of gaining title to land, and it's through either accretion or annexation. So accretion is by natural ways of gaining title, and then annexation is by man-made causes. So accretion, the best way of the example is like the gradual buildup of land within a waterway. So on a water course, there's the alluvium that would build up, so the soil that builds up and increases the amount of land that someone might own because of that increase in soil on their property. And due to that, who benefits most? Well, if you're adding land because of accretion, that landowner, that property owner, is going to be benefiting by the increase in the amount of land that they're owning. So the best answer will then be A, the landowner. Why, though, not the other options? Well, the local government entities, no, they don't benefit from this. It's the landowner, unless like maybe certain part of government entities that might own that actual land, but that's not really what they're talking about in general here. In general, they're talking about the landowner. The landowner could be a government entity, but that's not what they're saying. Water company, no, they're not the ones who will benefit most, because they're actually, there's more land actually being built up, and probably because of that, you would think just how it goes hand in hand, less water, but so the best option is A, the landowner. 5, a CLTA standard coverage policy of title insurance does not cover A, forgery, B, zoning laws, C, recorded items, D, improper delivery of a recorded deed. Well, remember about title insurance. We have CLTA as well as ALTA. CLTA is the California Land Title Association. It's the standard one, we say. So it covers a lot of just the basics when it comes to title insurance. Now, let's talk about what it does cover. Well, it covers all recorded items, forgery, incompetence, capacity, and improper delivery of a recorded deed. So let's break them down. So CLTA covers all items that have been recorded. It covers forgery. So forgery occurred in somehow in the conveying of the title, for instance. Also incompetence. If the person, for instance, that was actually selling the property was declared incompetent in a court of law and did not actually have the ability to convey that property, then the title insurance would cover that, as well as if the seller, for instance, didn't even have the capacity to contract. They were under the age of 18 and for some reason it fell through the cracks. They didn't find out, or who knows why. Usually these things are found, but just in case, the capacity, as well as improper delivery of a recorded deed. And if it wasn't actually delivered properly and it was a recorded deed. So these are the basics, as you can tell, of what CLTA covers for title insurance. So going through that, what does it not cover? Well, it does cover forgery. It does cover recorded items, and it does recover improper delivery of a recorded deed. So let's verify about zoning laws. Zoning laws is something that is not covered under CLTA for the standard coverage policy in California. Zoning laws are not covered. So that is the correct answer, B. And let's talk about a little bit about why zoning laws are not covered. So it does not cover zoning laws because local government entities place the restrictions on what can be built on a specific parcel of real property. So that is just something that the local government entities do. They place the restrictions because remember, zoning goes hand in hand with police power, and it implements the general or master plan. And it just says what can actually be built on a specific parcel of real property and doesn't have anything to really do with what title insurance will cover.
Thanks for watching. I hope this video was helpful in your licensing journey and your studies. If you liked it, make sure to give us a big thumbs up as well as subscribe to our YouTube channel so we keep producing new content. But if you have any questions or if you'd like to check us out for completing coursework to be eligible to take the state exam or even for preparation to help you prepare for the state test, we have tons of options and I have our website listed below. Otherwise, I'm Schyler with Accredited Real Estate Schools, and thanks for watching.